During the 2008 global financial crisis, and again during the COVID-19 market crash in 2020, portfolios invested in dividend-paying companies fared significantly better than pure growth portfolios. For example, US companies like Johnson & Johnson, Procter & Gamble, and Coca-Cola, known as dividend aristocrats, not only held their value better, but continued to pay consistent dividends through the downturns. These companies demonstrated the value of steady cash flow and long-term resilience. Investors who reinvested dividends during those dips saw faster portfolio recovery due to compounding effects. Dividends are regular cash payments made by companies to shareholders. They are a key component of total return, particularly over long periods. Benefits include stable income stream, reinvestment opportunity, signal of company strength and maturity, reduced portfolio volatility. Cash isn't just for emergencies. It plays a strategic role in providing liquidity during market downturns, allowing rebalancing into undervalued assets, serving as dry powder for new opportunities. Typical allocation to cash ranges from 5–15% depending on age, risk appetite, and market conditions. Dividend growth investing focuses on companies that consistently raise dividends. High-yield dividend investing targets companies with higher current payouts. Dividend ETFs, Vanguard Dividend Appreciation ETF VIG, iShares Select Dividend ETF DVY, Spider S&P Dividend ETF SDY. These ETFs offer diversified exposure to dividend payers with varying risk-reward profiles. Reinvesting dividends can significantly accelerate portfolio growth. Example, $10,000 invested in dividend stocks yielding 4% with annual reinvestment could grow to over $21,000 in 18 years, assuming 6% annual capital growth. Many brokers and ETFs offer automatic dividend reinvestment plans, DRIPs, which automate the compounding process. High dividend yields can indicate financial stress. Companies may cut dividends during downturns. Overconcentration in income stocks may reduce capital appreciation. Balance is key. Use dividends to enhance stability, not as the sole strategy. Dividends provide income, cushion volatility, and support long-term growth. Cash offers flexibility and resilience. Combine dividend-paying equities with growth assets to create a balanced, compounding portfolio. Next, we'll explore how to hedge your portfolio against short-term risks without compromising long-term goals.